Welcome back. And today we're going to discuss pricing and analytics of complex products and particularly credit, but we're going to look at the quantitative techniques and quantitative infrastructure for pricing and analytics complex credit products as well. Um, with that, specifically, I have two experts with me. Jason, could you introduce yourself?
My name is Jason Charlesworth. I have a PhD in theoretical physics. I have been quant and quant dev, running quant dev teams in front office banking for the last 20 years. More recently, I've set up my own firm to do high performance computational maths. So my real focus is on performance on modern hardware, how to get the best speed out in your calculations.
Brilliant. Perfect. And Kelli, could you introduce yourself?
Sure. My name is Kelli Sayres. I've been with Polypaths for 22 years, a fixed income analytical software company, and joined Numerix last August as part of an acquisition. So have had the pleasure of focusing with our clients on various structured product analysis, both US-centric and more global over the past year.
Great. Thank you. And I really can't think of anyone, two people better equipped to give us details of the quant infrastructure and modeling dimensions, if you will. So without further ado, I'll dive in. Jason, I'll start with you specifically. So from your perspective, what do you think are the key structural challenges in leveraging novel hardware or hardware that's not the CPU, if you will, GPUs, FPGAs, etc., for current quantitative techniques and quantitative applications, if you will?
Well, we're actually at a time right now where there are huge numbers of technologies coming on the market. You know, whether we're talking GPUs, FPGAs, whether we're talking, you know, the massive multi-core machines that AMD is rolling out with 128 cores, you know, whether we're talking the ARM processors on the cloud, TPUs and NPUs, there's so many technologies out there. I mean, I was recently as a presentation from Cerberus, and they had a machine with 900,000 processors all on one thing. It's a huge range of technologies. And the question is, these technologies give massive speed ups. And the question is, why aren't they more widely used in banks? Why are banks so slow to adopt them when using either hardware technologies or software technologies like algorithmic differentiation can give 10, 100, even 1,000 times speed up? And I think you really need to look at where successes have happened to understand what's going on. And so successes have often been in things like much smaller organizations, not major first-tier banks. Or where they are in first-tier banks, it's often in a small self-contained area like e-trading of FX exotics. So the real problems kind of fall down into two main challenges. One is management and one is physical. Management really is a case of you've got to think about how the libraries that are currently used in quant analytics are organized, how the libraries are organized, how they're used, and how the teams develop them. So if you've got a library, and let's say we're going to think about rolling out GPUs. We've got a library. This library is being used by a front office trader pressing F9 on a machine. It's being used by back office for the overnight risk. It's being used by a rates salesperson over on a rates desk. It's being used all over the place. So are we going to try and make everybody have a GPU? Because at the moment, an awful lot of banks, the calculation happens locally. A trader presses F9, it calculates on their machine. Different users. So we have this problem that we can't get everybody to use it. And if that's the case, if you're trying to make it so that some systems, maybe the overnight risk, use GPUs and others don't, you're in this problem of having a heterogeneous code base. You've got a code base for the x86, another for GPU, and it's a management nightmare. You can get inconsistent numbers, it's difficult keeping them in agreement. It's potentially, according to the regulators, 2 model sign-offs. So there are a lot of these problems. So the real route for that is you're going to have to think about changing your entire structure. You're going to have to think about all calculations need to be more server-based. When the trader presses F9, the calculation goes off to the server, is done on a single server. And in that way, you control the hardware better. So in many banks, some banks are already starting down this line. Other banks are a long way off. But it would require these structural changes. It changes also how you think about development. You know, if you're using FPGAs are very expensive. They're like $6,000 a board. So is every developer going to have one? It's a lot of management considerations that need to come in. And then on the other side, we have the physical aspects. There are a lot of issues with integrating things like FPGAs, GPUs, and so on into current hardware frameworks. So things like if you've got a server farm, you put a GPU into it. An A100 GPU, which is quite a nice GPU, takes 400 watts. An H100 takes 700 watts and will be a triple slot. It physically will not fit into your server rack. It won't fit into your blade servers. It won't fit into the cooling systems of them. So you have to think about the logistics a lot. It's as a result, you've got this problem with how do you roll them out? You also, another physical aspect is, do you really want to tie yourself into one particular hardware? If I tie myself into a particular vendor, am I going to be stuck with them? What if they no longer support that hardware? There are many of these issues, and they're not trivial to overcome. So as I say, where I've seen these being successfully deployed, it's either in smaller organizations or it's in organizations where they've chosen a small number or a small area and said, right, we're going to focus on this, we'll roll those out. In other areas, people have created frameworks where the framework the quants use is agnostic to the hardware. But you have to think about how it will be developed, how it will be used, how you will reconcile numbers that are different on different platforms. And this does require changes throughout the entire bank structure and how it's used.
So in many ways, you think it's really the management, the DevOps, the development cycle, and the whole development framework and the management of that development framework that's sort of critical and drives the.
Yeah, the technology is there. The technology is fantastic. Okay, let's not mince words. The technology is out there, is amazing, and can do incredible number of calculations. An x86, maybe you'll get 50 gigaflops at best from a single core. You can literally buy a GPU for like $10,000 that will do you 20 teraflops. The computational capability is not. Technology is not the problem. Management, how you're going to manage it, how you're going to develop within your current framework, how you're going to manage different prices, how you're going to ensure that everybody is using the same hardware. This is a management problem. It is not a technology problem.
Kelli, from your perspective as in Numerix as a vendor, do you see the similar challenges? Do you see a slightly different perspective, etc.?
No, I think it's a common challenge and opportunity everywhere, right? We have this amazing power, and sometimes I think of it similar to, just movie technology, right? You used to have practical effects. Now you have kind of the entire world at your fingertips in terms of what you can do. But in the structured finance space, CLOs, CMBS with complex deals, the computational power is so intense that is needed. So, there's a bifurcation about the number of scenarios you can run practically for, simple derivatives or even complex derivatives versus these multi-asset collateralized deals. But the same issue comes up, right? You want to use a consistent framework, you want to use consistent hardware. You don't want to hold someone back because some teams want to run, a different process, but at the same time, that naturally will create some conflicting assumptions. So it's definitely a challenge and opportunity at the same time.
And to both of you, do you think that the fact that the arrival of the cloud has changed that? Has the arrival of the cloud made adoption easier? I mean, a lot of some of the issues that Jason was talking about, including the challenges in the server rack side, the challenges in managing the physical hardware, some of that becomes perhaps a little easier. And even more so with the arrival of GPU-specific clouds like CoreWeave and others, has that changed the dynamic anything from a quant programming standpoint?
I think, I know that Numerix is a very large cloud provision, so I'm sure Kelli will be able to give a different take on it. But my experience is the first of all thing you need to really recognize is when we talk about cloud, everybody thinks Azure, they think AWS, they think Google Cloud. But practically there are two clouds. There's an external cloud and there's the on-prem cloud. So external cloud is fantastic for things like burst capacity. You know, banks use it for burst capacity when a regulator requires certain calculations, fantastic. For quant development, it has a huge opportunity. That is, if you're trying to get hardware into a bank, if you're trying to change things, it becomes quite tricky. But if, on the other hand, you're using cloud facilities, it's very easy to say, let's just try it using ARM processors. Let's just try using that GPU rather than that GPU. You don't have to buy them. You know, it's a very, very easy thing to allow investigation, to allow tentative steps into a migration. Now, on the internal cloud, though, I think that's a much bigger area that's growing. Virtually all the banks are moving from local machine to thin clients going to a server. I mean, they're all doing it to some extent. And it really kicked off an awful lot during COVID. And this has a lot of issues for the quant. The quant developing in such a virtualized environment is very, very difficult. The performance that you can get out of virtualized systems can be quite variable. It does simplify things. You can, if you've got a virtualized environment, as I discussed earlier, it means you can get a uniform and consistent hardware platform. But, you know, it does have some performance issues. So my take on the cloud is that the cloud can be fantastic. For other areas, especially for how a code developer, the quant and the quant devs work, it can cause problems. But as I say, I'm sure Kelli has a quite a different view on this from Numerix.
No, I think a lot of what you said is true. I think one of the main benefits is you can easily test things, right? I've been in these meetings before with clients, you know, a year ahead of a hardware upgrade. What should we do? What should the sizing be, right? You're making all these theoretical decisions. Now you could just do it, right? Let's run it. Let's see what the impact is. What is the valuation difference if we have a different kernel library? You know, what are we looking at? So I think the investigative part, you know, makes the paralysis of decision making lessened to a significant degree. We certainly have a lot of clients that are very happy to be able to scale their resources on the cloud. We have a lot of, you know, folks that are subject to a lot of regulatory scrutiny. So that dynamic burst capability is very useful. But on the other hand, we also have a lot of on-prem clients that use private clouds that have huge data stores, custom models, you know, a lot of data dependencies, and they prefer keeping everything, you know, in-house, but still being able to leverage, you know, the thin client, like you mentioned. So I think, you know, it's a wide variety of client needs, and I think the cloud in some way is best suited to planning and you know, quick decision making and scaling. But private cloud certainly has, you know, important benchmarks as well, and being able to get the exact hardware, you know, that you want rather than a pre-canned EC2 instance, as an example.
That actually is a natural segue to one of the struggles we've sort of observed is the issue of whether a quant should be hardware architecture aware. To what extent should quantitative modelers be thinking about where is the data stored, how fast is the connections, what is the nature of the data parallelism, what is the cascade of memory? Obviously they make a difference in performance. They make a difference and scientific programmers have been always used to taking all of that into account when they build their software for HPC environments. But to what extent financial quants should be thinking about those kind of issues? Jason?
So if you had asked me this question 10 years ago, I probably would have said, quants are expensive. Quants and quant devs cost a lot of money. Hardware is cheap. Don't bother about it. These days, I would say exactly the opposite. Every bit of hardware now is specialized. Every single piece of hardware that you have is specialized. And if you don't code for the specialization, you are throwing away a huge amount. So let's think about an x86 processor. If you've got an x86 processor and you're writing code very naively, and you're not thinking about memory, and you're not thinking about vectorization, you may get 3 gigaflops out of it. If, on the other hand, you're using AVX512 SIMD, you're thinking about superscalar, and you're thinking about cache-friendly approaches, you can get 50 gigaflops. So we're talking like a factor of 15 performance difference. If I were talking about a GPU, if I've got a 10,000 core GPU and you haven't coded thinking in terms of parallelism, you're getting throwing away 99.99% of the performance. So in every single thing, you have to think about it these days. And the problem is there are two reasons you have to really code for the hardware. One is computer languages are told the code. They see the code, but they don't see the intent. So you can have a lot of bits where the compiler can't understand what you're trying to do and can't do the best job. And there are movements in C++, like C++ stood for each, and C++20 concepts, etc., that are providing more information, but we're still a long way off. And secondly, algorithms. The algorithms that work on one hardware will not work on another. So if you look at, say, PDE solving, the algorithm that's been around for ages, since the 1950s, is the Thomas algorithm. It's rubbish on a modern x86, absolutely rubbish. It's like a factor of 20 slower than what it should be. You can use other algorithms. If you're doing it on a GPU or a massively parallel, you have to use cyclic reduction. Again, completely different algorithms. So we've got this huge problem. But I think the best one to look at is AI tools. If you look at the AI tools, if you look at TensorFlow or PyTorch or anything like that, nobody codes down to the bottom. The vendors do it. They produce the bottom layer. The person at the end who's doing the AI programming just uses the tool. And this is where I think we need to get to with the quant world. We can't expect everybody to be coding down to the bottom level. They should be at a higher level of abstraction. They should be saying, I'm doing a Monte Carlo, I'm doing a PDE, I'm doing this. The hardware, whether it's ARM, AMD, GPU, in the long term, should not be the quant's job. It's a task they can't keep up with. And I think we are going to have to move in that direction. That's my take on it.
Well, that's an interesting perspective. That really begs the question of what is the right library? What is the right point to which you go in the abstraction? Is it at the matrix level? Is it at the at a full library level, etc.? So with that, Kelli, I wanted to ask you a sort of related question: is what do you think is the analytical environment, the right and optimal environment for, say, structured credit products like CLOs, CMBSs, and so on? I mean, they are computationally intensive.
Sure. Yeah, so because of their, unique structure, we're talking, it could take a minute, 2 minutes to generate a cash flow in some instances for the most complex deals. It sort of changes the equation where you can't just throw, infinite scenarios at them for valuation. So it's really data driven. The analysis for CMBS, for example, the underlying assets are so important in determining performance, right? You're looking at retail space versus office loans, student housing versus other asset classes. And, because of that, clients and investors really need to look at that asset level, right? See what's backing the particular deals, make their assumptions at a geographic level based on appraisal values, loan size, consumer purchasing power, date of origination. So the common theme is really data and being able to narrow in where is my area where this bond is going to break or when something is going to happen. What are the factors that are driving this, and what do I need to consider? For CLOs, they have robust issuance and strong demand this year. Their floating rate coupons, provide a lot of insulation from interest rate risk. So the focus instead moves to the embedded call provisions and making sure that folks are looking at cash flows to worst or even probabilistic cash flows, looking at their analytics across a variety of refinance or reset perspective. So, every asset class has its particularities. And I think because they, are so computationally intense, there's a focus to make sure that you really understand what's behind those deals, can really understand the drivers that impact the performance of those assets themselves, and then use that information for a really granular assumption. And once you have that granular baseline assumption, you can stress it back and forth. But I think these asset classes in particular start with that deep dive all the way down to the borrower and asset level.
In many ways, the performance is all about having granular data, better data analytics, and the faster and more efficiently you can mix, match, model the data. That's where the sort of performance gap in a lot of these instruments would be. Would that be broadly the thesis that?
Yeah. Yeah, absolutely. It's the combination of the both. And then, the challenges Jason highlighted with being able to harness the resources available to you, because it really does matter, right? Performance for these assets in particular might mean being able to run 10 additional stress tests. So these are, really important considerations.
And sort of going on the same path, what about the challenges of sort of simulation and stress testing credit spreads and across the sort of across the across a lot of different credits and so on, if you will?
Yeah, sure. So, I mean, we've seen a few different approaches. Some are at this still granular level, looking at the actual default events or transition events and trying to model those, using different scenario generators to produce these credit migrations. Other folks kind of start with their deep down view, come up with a spread, and then just stress the spread as as a proxy for everything, right? Everything that could go wrong or right with liquidity, with volumes, with underlying credit worthiness. So, the main thing is it's not just the level of these shocks, both to spread and to rates, but it's the timing of them, right? There's so much uncertainty in terms of what the rate paths are going to look like. And it's not just the T0 analysis, but if you're an investor, you're going to do something with that cash as things start coming back. So what are you going to catch on the way down? Assuming we're going down a, rate decrease path, what are you going to do in terms of a reinvestment assumption? So that also kind of works hand in hand with the valuation impacts at T0. So I think, the more scenarios you're able to run, the wider your envelope, the better position you'll be in to make those decisions and actively manage your portfolio.
So that was really my last question, and really in some ways that shows that the demand for greater computational complexity is there. There's plenty of complex structured products, complex scenarios, complex situations, which we need this extra computational capacity that's available through GPUs, FPGAs, and even just vectorizing your code. But obviously, there are significant challenges, some of which we saw today. A lot of it perhaps can be handled through management structural changes or libraries or frameworks, an environment that financial institutions need to look at and explore. But with that, thank you both, Jason, Kelli, for sort of illuminating a little bit of an area which we've been thinking about a bit, but I think is really critical to the industry going forward. Thank you.
Thank you.